So using a soccer or football analogy, you will need strikers, midfielders, and defenders and goalkeepers. That's the idea. You need a team that will be balanced.
Thank you for joining us for part 2 of our interview with European money manager Diego Parrilla. If you haven't yet watched part 1 of our discussion with Diego, in which he explains why he sees the world's central banks as increasingly challenged to preserve market stability as stagflation and volatility heat up from here, head over to our channel at youtube.com/Wealthion and watch it there first. It sets the context for the investment perspective that Diego and our partners at New Harbor Financial share in this video. Oh, and if you haven't yet, don't forget to subscribe to this channel by clicking on the red subscribe button below, as well as the little bell icon right next to it. And now, let's get to part 2 of our interview with Diego Parrilla.
And so effectively, this concept of anti-bubble, which I think it's now being widely understood and accepted, is powerful in multiple ways, and it gives us a tool to try to build portfolios in this highly artificial world. So with that, I go to the last part of your question, which is a very loaded question, which is how do we build a team? And I'm going to tie it up with my comments on risk and inflation. So using a soccer or football analogy, you will need strikers, midfielders, and defenders and goalkeepers. That's the idea. You need a team that will be balanced. And so on the striker side, you could think of assets like equities or credit or others, right? What's the difference between them? The key difference between them is whether you're long inflation or short inflation. And here, part of the problem, in my view, and something to avoid, is strategies that are short inflation, such as cash, fixed income, or credit. So put it differently. In a risk-on world where things are going well, equities are doing well, credit's doing well, if inflation is super high, the $100 that your bond will pay you back, your AT&T bond, that will give you $100 back in 10, 20, 30 years, are going to buy you nothing. So even if you made money in nominal terms, you lost big time in real terms. So in my view, the strikers should be favored to some sort of equity, okay, relative to credit. On the midfielders, I think you want to favor real assets clearly to cash or uncorrelated strategies. And on the defenders, and this is slightly different in the US, okay, but in Europe it's very clear. You favor anti-bubbles like gold or volatility to fixed income. When your Bund, the German Bund, it's already at negative nominal yields all the way out 30 years, the room for the Bund to defend is very limited, okay? Unless you go deeply into negative nominal yields. And this is why for those who follow soccer, there's a famous, a legendary player in Germany called Beckenbauer. And I call the Bund Beckenbauer because it was a great defender 30 years ago, not anymore. And that's the dynamic that we're feeling. So I think you want to build a portfolio on the risk side. You want to have, I think you need to favor equities to credit. On the midfielder, I think you want to favor income, real assets with income. And on the defender side, I think you want to favor things like gold or volatility. And you basically want to avoid things like cash, credit, or fixed income. Although, as I said, in the US, the nominal yields are still high enough that there's plenty of room for upside, especially in the 30-year. And if you think about them in also with the room for inflation, like tips, I think it could be interesting. So the US fixed income still has some juice left. In Europe or Japan or Switzerland, that situation is more dire. And why I think owning asymmetry on the defender side through other assets like gold is superior to fixed income.
All right, that was excellent, Diego. Thank you. And if you don't mind, I just want to recap real briefly to make sure I got the notes right. I'm going to use your striker, midfielders, and defenders analogy here. When you say strikers and you say favor equity over debt, do you sort of look at it as a striker as a risk-on long inflation play? So in other words, like if the Fed is successful in doing what it's trying to do, these are the companies that are going to benefit from that?
Yeah, strikers are strategies that are risk-on. They do well if the world does well. The inflation side, it's an additional consideration. Not all strikers will do well with high inflation. So your AT&T bonds will pay you your money back. Therefore, they made money in nominal terms, but they did very, very poorly in real terms with very high inflation.
Right. But like the ARCs of the world are going to do well in that risk-on world. Not that I'm saying that that's necessarily the striker you want to put in your portfolio, but it's those are the types of companies that'll benefit from the risk-on environment. The ones that have been benefiting pretty well over the past couple of years.
You want to, I think this is what Ray Dalio would call MP3 assets. You want assets, strikers that will do well in a highly inflationary environment. And you need to look for which ones those will be. They will benefit from the monetary and fiscal stimuli, and there are many you could look at.
Yeah. Okay, great. So then the midfielders, you say real assets with income. So I mean, this could be like an individual buying real estate to rent out and get an income stream from that. In the markets themselves, would this be like buying like commodity producers that pay dividends?
Yeah, it could well be as well. Absolutely. I think you want stuff that you cannot print.
Yeah, so exactly.
Things you cannot print are real assets, are commodities, etc. We need to be a little bit careful sometimes with the commodity equity, because in a funny way, some people think about, let's say, gold miners as a call option on gold. And that is true, except that there's additional risks that we all know. But in particular, there's some wrong way exposure with respect to taxation, expropriation, and nationalization. So when oil, for example, was at 140, 150 bucks, production sharing agreements had 99% taxes. With oil at those levels, assets were being expropriated. And even we had extreme cases like Repsol in Argentina, where the company was nationalized. So we need to be a little bit careful between the difference between the commodity and the equity, whereas, yes, I agree they're a call option, but it has a knockout feature. And also all sorts of potential basis risks that include taxes or storage or many other things that make the picture more complicated. But generally, you want things by midfielders, things that are less directionally driven with lower beta per se, that even alpha long short strategies could be great. Okay, if you have the right source. It's uncorrelated alpha, but I think when you think about parking your money with cash, in the short term it can make sense. In the medium long term, you really suffer from that. And so I think the real estate and land, especially with some sort of income, is favored.
Okay, great. And then in defenders, that's the true anti-bubbles, right? And you listed gold. Yeah. You've already talked a lot about volatility. So having volatility there basically as a hedge on the portfolio. Okay, so if that's all sort of a correct understanding, given how you see the landscape right now, how are you allocating the Quadruga portfolio amongst these three? Is it an even third in each, or are you more weighted towards your strikers or your anti-bubbles?
Yeah, so we have the Quadruga is a 1.8 billion asset and wealth manager. I'm managing partner and I run one of the largest strategies. And we have two main solutions. Okay, so we have individual players, literally. So I run one of them. I happen to run a strategy that is the goalkeeper. Okay, I'm the defender. But we also have other strategies. So for example, I'm very proud that a former colleague of mine at Goldman and Merrill, former head of prop trading, has recently joined us, Christian Thum. He's an equity long short guy. So he's more of an offensive midfielder. Okay, so we have all these individual pieces available. So investors could come in and say, well, I have a great striker, but I like this goalkeeper, or the other way around. Now, we have a separate, so my strategy of anti-bubbles is primarily precious metals, US Treasuries and tips, and options. And I have 50% in precious metals, 30% in treasuries and tips, and 20% in options. But that 20% in options is invested in stuff that on average could pay 10, 15 to 1. So it's extraordinary. We only buy options. So that 20%, I was the best performing hedge fund in the world in February last year, and one of the best throughout the crisis. We're up 10% in February, 19 in March, about 45% in the quarter. So we did this partially because even if I was long gold and treasuries, which fell during that period, gold particularly, things like call options on the VIX or calls on the dollar, which are also defenders, did extremely well. And the optionality that we have there is super asymmetric. The second way in which people can invest in our funds is through investing in the entire team. And that entire team is called Quadruga Stable Return. But anyway, that's sort of fun that if anybody's interested in discussing further or learning more about the strategy, we could do that.
Well,
a bit too technical for the average crowd.
Yeah, but thanks, Diego. I mean, we on this program, we really beat a drum that this market is so much more complicated than the market that many viewers sort of, grew up with. And we're in such a treacherous time right now where there's so little margin for error of the Fed trying to drive things here, that we could have, some of these downdrafts at any moment in time, like you said. So we really do recommend that people, wherever possible, work under the guidance, supervision, partnership of professional financial advisors like you and your team, because the average person kind of gets the strategy of what you're recommending about building the team and rebalancing and all that stuff, but they don't have the experience or the bandwidth to do so in many cases. And so to work with somebody who just is a specialist in that, we think that's really the much better way to go. All right, so I'm looking at my list of questions here, Diego. We're coming up on the hour mark, and I don't even know if I got halfway through it. So I'd love to have you back on at some point to dig into these other questions that I have here. But in the meantime, for people who have enjoyed this conversation and would like to follow you, learn more about you and your work and whatnot, where should they go?
Well, they can reach out via Twitter. Just follow me at Parrilla Diego, Parrilla with double R and double L, and Diego like San Diego, or via LinkedIn. I got a lot of people connecting through LinkedIn, and we have a distribution list and monthly calls. So I'm generally very happy for people to come in and exchange views and stuff. And yeah, so that we can, if they're interested in reaching out, they can, and I can send them, my team will send them more information about what we do and if and how it might be a good fit to what they're trying to achieve.
Fantastic. So when we edit this, Diego, I'll put up your Twitter handle on the screen there so folks can easily find their way to that. Well, thank you so much. You've given us just a massive download of just wonderful insight and really some great frameworks I think that we're going to continue to talk about in this program going forward, because I think they're really useful. Thank you so much for all your time. Thanks for staying up later in the day, your time there in Spain, and really look forward to having you on this program again in the future. It's
been my absolute pleasure, and thank you for waking up so early so we can make it work. But anyway, have everybody good luck, stay healthy, and I look forward to continuing the dialogue. Thank you a lot.
All right, John and Mike. Well, as we do every week, let's first unpack what Diego had to say, and then let's turn our eyes briefly to what the markets have done since last week's video. Mike, why don't I start with you? What's your general reaction to Diego's perspective there?
Yeah, let me just say a few words, Adam, and then I will get to what the market has done, which is essentially more of the same of what it's been doing. Really enjoyed that. Diego talked a lot about some of the same things that we're concerned about. One thing that he mentioned that I wanted to highlight and bring up again is the duration of the stock market is long, 50 years. I mean, I think he said the NASDAQ has a 50-year duration. We think it might even be higher. There's some different ways to measure that, but basically a duration means it's a measure of cash flow and the net present value of cash flow type things. It's a calculation that the bond market often uses, and people are saying that, well, the S&P or the NASDAQ is cheap relative to interest rates. it's not really true. When you take a look at the duration of the market, it's there's a lot more risk embedded in a long duration asset because a small change in interest rates changes the net present value a lot. So it's just another way of saying that the risk is extremely high. Um, Also liked how he talked about, categorizing different positions, strikers, midfielders, and defenders. He talked about having gold and volatility. We certainly agree with that. We're big believers in gold bullion, holding it personally, if possible, plus gold miners and silver miners. Volatility is interesting. Volatility right now is around 17 on the VIX. It could easily go to 100 in the span of even a few weeks, maybe a few days, but probably more like a few weeks if that happened. Last year I think it got close to 100 during the coronavirus time frame. And I think Diego was saying that if you hold VIX, you can get a lot of bang for a little bit of cost in terms of premium. It's hard to hold VIX. It's very hard. You just have to accept bleeding money for quite a while. I'm not sure exactly how he's doing it, but he's probably just buying call options on the VIX and rolling them every month. We could see that as a viable strategy potentially, as long as you write off that money and say, well, I'm going to just spend a couple percent a year or whatever it is on VIX call options. It's a viable strategy. Something that John and I talk about, never have implemented anything like that. We certainly understand that strategy. Could also do some kind of bull spread on VIX where you buy one VIX call option and sell another one deeper out of the money. It's probably beyond the scope of this talk to tell people how to do that, but it's certainly something that could make sense. I guess lastly, as a defensive move, you could just buy puts on the S&P as well, except buying calls on the VIX might have a little more juice to it. So that makes sense. Lastly, I guess I'd say, and I'll let kind of John chime in on things that I mentioned here, but he thought maybe there would be a trade in 30-year bonds, even though that rates are low here in the United States. They're still higher relative to the rest of the world. And we have a position, about a 10% allocation to US Treasury bonds, longer term, 20 plus year bonds. And that's more for a short-term trade for us. So certainly we agree with that. I think that we probably hold more cash than Diego agrees with, but we certainly wouldn't want to have to say that we have to match on anything, but we have a lot in common with what he said.
Great. John, fire away.
Yeah, I would love to pick up the baton on the duration point that Diego and then Mike talked about. It's a kind of a little bit of an esoteric concept for the layperson. It's actually very analytically correct framework for investment managers to think about things. But I'd like to kind of translate to the layperson what that means. Duration is kind of a measure of the length of time to get your return from an asset, right? The longer the duration, the longer it is to get that return, basically, right? And when you think about individuals, families, couples, as we work with, that's who our clients are. You think about time frames. Common question for financial advisors to ask their clients is, what is your time frame? What is your time frame for needing these funds? And when you get a situation where the stock market is priced with a quote unquote duration of 50, 60 years, like it is now in many buckets, that's the equivalent of saying that, you better not need this money for 50 or 60 years, right? So long-term, if one's going to call themselves a long-term investor, they better be thinking really, really long-term. In fact, longer term than most people's life expectancy would likely be in retirement. That's what happens when valuations get as stretched as they are right now. The risk inherent and the return, modest return embedded in things like stocks create a situation where the time frame is oftentimes way longer than the reality of the time frame of the investor. I hope that helped bring to a practical level what we mean by duration, because that's really what it means from a practical standpoint. But yeah, I thought Diego painted a really nice broad construct of, I think he properly, acknowledged the almost the entrapment that the policies over the last decade have created. That every successive minor shock has to be met with even more of rescue kind of stimulus, and that quite likely inflation can be an issue, and we're seeing some of that start to. We've talked about that pretty intently over the last several episodes of these videos. Yeah, and the one final point I make, and he did acknowledge that when you look at, apples to apples, the stock market relative to longer term bonds, which is really the better comparison, the stock market is overpriced relative to even those longer term bonds. But the added point I would make is those bonds themselves are overpriced relative to their fundamental and historically. So it's kind of like comparing a $150,000 Honda Accord to a $160,000 Toyota Corolla and saying one is better value than the others. It's just,
they're both crazy overpriced.
Exactly. So just a couple random comments there.
Yeah, no, that's a great analogy, guys. Well, look, I'll let you guys comment on what the market has done over the past week. To my side eye, as I've been busy preparing for the conference, it looks like it hasn't done all that much. It's sort of been trickling back up again. But I do want to note that, Diego talked about both his midfielders and defenders were really natural resource plays for the most part. He said, hey, he really likes real assets with income. Those are his midfielders. And then for defenders, he likes the anti-bubbles, which are, hard assets like gold. And I know that, you guys at New Harbor have a pretty good position in gold. It's one of the few areas where you've got a real long position. And I just want to note that over the past bunch of these weekly videos that we've done, we've heard again and again these experts come back, most of them, to recommending the precious metal space in some way, shape, or form, whether it's because they're concerned about inflation, whether, like last week with Rick Rule, the natural resources investor, because he knows the actual geological data and is saying, look, there's just a lot less coming out of the ground these days, particularly because of underinvestment in the space for the past couple of decades. And then you have people like Bill Fleckenstein, who are saying, hey, these commodity producers, particularly in the precious metal space, they are better positioned than he's seen them for much, if not all, of his investing career. And he said he loves buying them because you can still buy them at 1980s valuation levels today, which you can't say about any other asset. And where I'm going with this is, when you see people from all different disciplines who have different methodologies for arriving at their conclusions, but they're arriving at the same conclusion, it's really compelling. It's really a time to sort of sit up and take notice and say, okay, look, there's a lot of different paths that are getting to the same destination here. That means that destination is probably quite likely to actually, be reality-based or be more likely to happen. So I just want to paint that target because we're going to talk in a second about the upcoming conference, Wealthion conference on June 5th. I've been meeting with some of the speakers, seeing their presentations, and they think very similarly too. So, Mike, let me flip it over to you there. But anything you want to say about kind of all roads seemingly beginning to lead to gold here, and then tell us anything notable that the market's done in the past week.
Well, the speculation in this market is just relentless, and it comes in waves and waves and waves. And just when you think it might be over, it keeps coming back. It's the biggest bubble ever, or at least the biggest bubble during my lifetime and all of our lifetimes, I think, probably people that are alive today. Just take AMC Entertainment, for instance, the movie theater stock. It's basically gone from 12 to 30, close at 26 in 1 week, almost tripled. It's like 6 or 8 times more valuable than it was a year ago. And if you take a look at GameStop, it's up again, taken off again.
Right. And sorry, just to note though, for AMC, like the main business for that company has basically been shuttered for the past year.
I know it's all wild speculation. It's crazy, but meanwhile, SPACs, special purpose access vehicles, sorry, I can't speak, have rolled over in a big way. And at the same time, new issuances of IPOs have mostly dried up, and Bitcoin lost half its value in the span of 2 weeks. It's since bounced back towards 40,000, regaining some of that. But that's what I mean by this rolling speculation that just kind of goes in waves and waves, and seemingly it's relentless. It's probably signs of a topping market, but it is relentless. The market itself has drifted higher in the last week. The S&P is right at its all-time high. Maybe up 50 points on the week. Bond yields are pretty steady. VIX is around 17, isn't saying anything really that special. Not a lot to report other than just the waves of speculation that we keep seeing going from pocket to pocket to pocket in the market.
All right. Well, thanks for that recap, Mike. And I hate to say it, I can see your frustration in this market's sort of refusal to bend to gravity and to at least, let any of the speculation out. Preparing for this conference that's coming up, David Hunter is one of the speakers there. You're really not going to like to hear what he has to say in the short term, because he still sees this melt up basically going parabolic before it then has a massive collapse, over 65%. And if you want to know the reasons why, go come see the conference. But he does see it getting even nuttier